Hey guys, Jack here from FX Education. In this video, we'll be tackling one of the biggest scams of all time. And no, I don't mean the $30 million that you've inherited from a long lost family member in Nigeria. It is of course the beautiful combination of both interest rates and inflation. Also guys, make sure you stick around until later on this video where we'll have Pete from Conversation Money joining us to give some awesome tips on how you can invest your cash better in 2021. Without further ado guys, let's get into today's video. So what if I told you your bank was scamming you every single year and probably has been since you're old enough to set up your very first bank account? In fact, if you fall into the admittedly very skewed bracket of being an average saver in 2019 with a nest egg in your bank account of £26,403, you'd have lost an almighty £494 in that year by having your money tucked nicely away in a safe and sensible bank account. Before we dive deeper into how this works, and more importantly how you can reduce the effect of this on your savings, I first need to give a disclaimer. This is not some sort of anti-retail bank style video where I suggest you hoard all of your money in some sort of decentralized, unregulated cryptocurrency, and by no means am I saying that I've outsmarted this scam myself. Sadly, I too fall victim to this nationwide problem, as I also need to keep a certain amount of my money in my bank account, as unfortunately if my car breaks down on the motorway, I don't think the AA mechanic will be too happy to sit for a day whilst my withdrawal comes through from my trading account. The first part of this problem stems from something that we've mentioned previously in our gold video, which you can find somewhere on the screen. This is of course inflation. Inflation is essentially when the amount of money in the economy is growing at a greater rate than the output of the economy, which at the moment is really prevalent here in the UK due to Brexit and not to mention the coronavirus, which is obviously affecting the whole world. Because of this issue, what we're basically seeing is an inflated currency, which means that your buying power of the currency is diminishing, and as a direct result of this, economic remedies such as quantitative easing and interest rates are more likely prevalent. More of those though later on in the video. So if we take a look at the ONS data, which you can see on the screen now, at the time of recording this video, which was at the end of 2020, we can see an inflation rate of around 0.8%. This basically means that over the past 12 months, your purchasing power has decreased by 0.8%. This probably explains why in 2050, a Freddo will cost around 50 quid and you'll have to pay for it on finance. All jokes aside, you need to keep the figure of 0.8% inflation in your head as you move on to the next silent killer, which is of course central bank interest rates. For this part of the video, we'll be referring to the Bank of England for interest rates and inflation data. As we are in the UK, therefore applying the Federal Reserve interest rates would be a little bit pointless. If you didn't already know, here in the UK, the Bank of England has the job of setting interest rates, and currently they're set at 0.1%. This is classed as the base rate and will influence the interest rates that banks like Santander and other high street banks offer to their customers, just like us. If we currently do the maths using a 0.1% interest rate, if you had a fat £1 million in your current account, you'd make a grand total of £1,000 interest in that account. To put this into perspective, when I was younger I set up an under 18s Halifax ISA account which offered me a 5% fixed interest rate for 5 years. This means to get the same interest rate as you would currently get from £1 million, I would only need £20,000 in the account, which is a smooth 50 times less. So now let's uncover how these two figures interacting are robbing you of your savings every single year. Let's imagine you've been a good saver and you have £10,000 in your savings account. We need to look at the two percentages that I mentioned before, which are 0.8% for inflation rate and 0.1% for interest rate. To figure out how much you'll be losing each year, it's super simple maths. You just do 0.1%, which is the interest rate, minus 0.8%, which is the inflation rate. This will essentially give you a net interest rate, which in this case is minus 0.7%. To then figure out how much you'll be losing, you can just take 0.7% away from your £10,000 which you've got in your savings account, which would leave you with £9,930 after a year, meaning a total loss of £70 for that year. But you may say, well Jack, that is all well and good, but I've never seen any money leaving my bank account as a charge for inflation. So you must be with Scamtander and not Santander. Well, you're sadly wrong. The effective inflation rate being greater than the interest rate in your bank is a bit like climate change. Some people do all they can to stop it, some people don't even acknowledge it, and some people just don't care because you only live once. And who needs savings anyway when you can always use Klarna? This ultimately comes down to inflation making your money worth less each year, meaning you'd pay £1 for something this year and eventually having to pay £1.07 the year later. When they're scaled up to things such as the price of a house, it becomes pretty clear why your granddad was able to buy his house for 25 pence and a cool little handshake. So Pete, why don't you tell the audience exactly how they can stop this from happening with some different types of investing that they can get involved with which don't need a degree in economics?
Thanks, Jack, and welcome to this section of the video. I'm going to be talking you guys through how you can combat the effects of inflation and low interest rates. And look, low interest rates have been around now for the last 13 years. However, there are things that you can do to make your money work harder for you. So I'm going to be talking about investing. I'm going to be looking at two approaches that you can take when you're looking to invest, the pros and cons of each, and I'm also going to talk you through or point you in the direction of who you can use if you're trying to make your money work harder for you. So first, let's talk about investing. What is this all about? So investing this year in particular has become very, very popular. And the idea of investing is that you buy an asset, a stock, a commodity, and something of some kind that you can sell for a profit in the future. Now, investing has been around as a concept for many, many years. And when it was first invented all those years ago, its primary purpose was to ensure that you could at least maintain the purchasing power of your money, i.e. beat inflation, or at least keep up with the rate of inflation. Since the markets were invented and investing, became a big thing, the markets have always returned very, very well historically over the long term. And this brings us to the two approaches that I'm going to talk you through. The first one is active investing. Now, active investing is all about you being the captain of your own ship, essentially picking your own stocks, making your investment decisions, whilst also trying to manage your investment risk as well. For many people, this can be quite a complex process, but for some people, they like to enjoy it. Now, with active investing, you can also have a look at trading as well. I always look at the two separately because when you're looking at investing, you're talking probably more long-term, medium-term investment strategies and timelines. Whereas with trading, oftentimes what you're looking for is you're looking for a profit in the near future or the short-term future. So very, very different. So active investing means that you're captain of your own ship. You pick your own stocks. And let's face it, who doesn't want to own a little bit of Tesla or Neo or Amazon and a number of other stocks that I could reel off right now that I'm sure that you've heard of, and it's sexy to own these things. Who doesn't want to be an investor in those kind of companies? But being an active investor does have its advantages and its disadvantages. Now, one of the big advantages about being an active investor is that you get the autonomy. You get the sexy part of the job in terms of selecting the kinds of stocks that you want to buy. So is Tesla the right buy for you? Is Neo the right buy for you? Do you want to go and buy Airbnb? They literally IPO'd this week. You get to select what companies you want to invest in. But with that, there is also a bit of a downside in the fact that the onus of the research is down to you. You're not outsourcing this to Sarah or Jane in an investment house to make those investment decisions for you and manage it. The onus is all on you. And therefore it means that if you don't do your research properly, if you don't understand what you're doing, then you could potentially lose a little bit of cash, therefore increasing your risk tolerance quite a bit. So whilst active investing is very, very sexy and very, very appealing, particularly with the likes of Trading 212, who is a great platform that you can use where you get a free stock just by signing up to get you started, the onus is on you to make sure that you're buying the right companies for the right reason. You're looking through their financials. You're looking at fundamental technical analysis to make sure that you are buying the right stock and picking the right stock and building a portfolio that is risk weighted according to the level of risk that you want to take. It's sexy, it's great, but it can be a lot of work. And I'll leave a link to Trading 212 so you can download and get a free share with Jack so you can have a look at it in the description section. The second way that you can invest is by being a passive investor. And when I say passive, it really is being passive. It means you're sending cash to a company and they've done all of the research on your behalf. They've curated companies and they essentially invest into those companies that have already been pre-selected for you. It takes away a little bit of the sexiness because you don't get a say as to what companies they buy. They might decide that they don't want to hold Tesla for whatever reason. They may decide that they don't want to hold Airbnb for whatever reason. They may be only looking at companies like Apple or Facebook or Disney, Coca-Cola. There's quite a lot of companies. Their investment strategy is all determined and agreed by the person that you outsource to. And that in itself is an advantage because you have a professional body, a professional company, a professional team doing the research on these companies and making professional investment decisions in terms of whether they think a company is a good buy and worthy to hold your cash as an investor. But with that, there is a downside. Because you are employing a team, you've got additional costs that you won't have as an active investor. And that's probably something that I should have mentioned before, but as an active investor, your cost is pretty low, particularly if you're going to use the likes of Trading 212, Stake, and a host of other companies and apps are out there right now where you can access the stock market with zero commission. It's very, very attractive. If you're a passive investor and you outsource this, you've got to pay a little bit more in terms of fees, so it increases your cost margin. A key consideration for you to bear in mind as an investor. But what should you do? If you're looking to beat inflation and low interest rates, then you've got two options. The question will be, are you the kind of person that wants to be hands-on when it comes to investing? Do you have the ability to research companies adequately? Do you know how to read financial accounts? Do you research the markets or look at particular sectors? Do you hold an interest, for example, in a particular sector? If you work in health and fitness or pharmaceuticals, for example, do you have any inside knowledge of your industry that may influence what companies you buy? Is it a sector that you understand? These are all fundamental things that really do make a difference when you're looking to be an active investor. If the answer to all of those questions are no, then perhaps, just perhaps, passive investing is the way forward for you. But I hope you find that useful. I'll see you in the next one.